Hello and welcome back. Today we are continuing your economics exam preparation series. This is topic 7. We are discussing national income. This topic appears in your exams every single year. In this lesson, you will learn the meaning of national income, the different measures of national income, gross domestic product, gross national product, net national product, the methods of measuring national income, the difficulties of measurement, and how to answer exam questions. Let us begin. First, what is national income? National income is the total value of all goods and services produced by a country over a given period of time, usually 1 year. It is a measure of the economic activity of a country. It tells us how much the country produces. It tells us how wealthy the country is. It tells us whether the economy is growing or shrinking. Governments use national income figures to plan economic policies. Businesses use them to make investment decisions. Economists use them to compare countries. There are several different measures of national income. The most common are gross domestic product, gross national product, net national product, national income, personal income, and disposable personal income. Let me explain each one. Gross domestic product, or GDP, is the total value of all final goods and services produced within a country's borders in a given period of time. GDP includes production by foreign companies located in the country. It excludes production by domestic companies located abroad. For example, if a Japanese car company has a factory in Nigeria, the cars produced in that factory are part of Nigeria's GDP. If a Nigerian company has a factory in Ghana, the goods produced there are not part of Nigeria's GDP. They are part of Ghana's GDP. GDP measures domestic production, regardless of who owns the factors of production. Gross national product, or GNP, is the total value of all final goods and services produced by a country's citizens and businesses, whether they are located in the country or abroad. GNP includes production by Nigerian citizens anywhere in the world. It excludes production by foreign citizens within Nigeria. For example, if a Nigerian citizen has a business in Ghana, the output of that business is part of Nigeria's GNP. If a Japanese citizen has a factory in Nigeria, the output of that factory is not part of Nigeria's GNP. It is part of Japan's GNP. GNP measures production by citizens regardless of where the production takes place. What is the difference between GDP and GNP? The difference is net income from abroad. Net income from abroad is the income that residents earn from abroad minus the income that foreigners earn within the country. If residents earn more from abroad than foreigners earn within the country, net income from abroad is positive. GNP is greater than GDP. If foreigners earn more within the country than residents earn from abroad, net income from abroad is negative. GNP is less than GDP. The formula is GNP equals GDP plus net income from abroad. Net national product, or NNP, is GNP minus depreciation. Depreciation is the wearing out of capital goods. Machines wear out. Buildings get old. Vehicles break down. Every year, some of the country's capital stock is used up. Depreciation measures this loss. NNP is a better measure of net production than GNP because it accounts for the capital that was used up in producing the output. The formula is NNP equals GNP minus depreciation. National income is NNP minus indirect taxes plus subsidies. Indirect taxes are taxes on spending, like sales tax and value-added tax. Subsidies are payments from the government to producers to lower the cost of production. National income measures the total income earned by residents of a country from production. It includes wages, rent, interest, and profit. Personal income is the income that households receive from all sources. It includes wages, salaries, rent, interest, dividends, and transfer payments from the government like pensions and unemployment benefits. Personal income is less than national income because some income is not received by households. For example, corporate profits that are kept by companies as retained earnings are not received by households. Disposable personal income is personal income minus personal taxes. This is the income that households have left to spend or save after paying taxes. It is the most important measure for consumer spending. If disposable personal income rises, consumers will spend more. If it falls, they will spend less. Now let me explain the methods of measuring national income. There are 3 main methods: the output method, the income method, and the expenditure method. Each method should give the same total. They are three different ways of measuring the same thing. The output method measures the value of all final goods and services produced. The income method measures the income earned from producing those goods and services. The expenditure method measures the spending on those goods and services. They are equal because the value of output equals the income earned from production, which equals the spending on the output. Let me explain the output method. The output method adds up the value of all final goods and services produced in the economy. It is important to count only final goods, not intermediate goods. Final goods are goods that are sold to the final user. Intermediate goods are goods that are used to produce other goods. If you count both, you will double count. For example, flour is an intermediate good when it is sold to a bakery to make bread. The bread is the final good. If you count the flour and the bread, you have counted the flour twice, once as flour and once as part of the bread. To avoid double counting, economists measure value added at each stage of production. Value added is the difference between the value of a firm's output and the value of the inputs it bought from other firms. Adding up the value added of all firms gives the total value of final goods and services. Let me give you an example. A farmer grows wheat and sells it to a miller for 100 naira. The miller turns the wheat into flour and sells it to a baker for 150 naira. The baker turns the flour into bread and sells it to a consumer for 250 naira. The value added by the farmer is 100 naira. The value added by the miller is 50 naira. The value added by the baker is 100 naira. Total value added is 250 naira. That is the same as the value of the final bread. Counting value added avoids double counting. Now let me explain the income method. The income method adds up all the income earned by factors of production. This includes wages and salaries paid to labor, rent paid to land, interest paid to capital, and profit paid to entrepreneurship. The sum of these incomes equals the value of output. This is because the revenue from selling output is distributed to the factors of production as income. The income method also includes depreciation and indirect taxes minus subsidies to get from factor income to market prices. Now let me explain the expenditure method. The expenditure method adds up all spending on final goods and services. There are four components of spending: consumption spending by households, investment spending by businesses, government spending on goods and services, and net exports, which is exports minus imports. The formula is GDP equals C plus I plus G plus X minus M. Consumption is spending by households on goods and services. Investment is spending by businesses on capital goods like machines and factories, and also on changes in inventories. Government spending is spending by all levels of government on goods and services. It does not include transfer payments like pensions. Net export is export minus import. Exports are goods and services sold to other countries. Imports are goods and services bought from other countries. We subtract imports because they are not produced domestically. Now let me explain the difficulties of measuring national income. Measuring national income is not easy. There are several problems. First, non-market activities are not included. When you cook your own food or clean your own house, you are producing something, but it is not sold in the market. It is not counted in GDP. When you do work for yourself, it is not counted. When you do volunteer work, it is not counted. This means that GDP underestimates true economic activity. Second, the underground economy is not included. The underground economy includes illegal activities like drug dealing and smuggling. It also includes legal activities that are hidden from the government to avoid taxes. People who are paid in cash and do not report their income are part of the underground economy. In some countries, the underground economy is very large. GDP does not measure it, so official GDP is lower than actual production. Third, the quality of goods changes over time. A computer today is much better than a computer 10 years ago, but GDP counts one computer as one computer. It does not fully account for improvements in quality, so GDP growth may underestimate true improvements in living standards. Fourth, environmental damage is not subtracted. When a factory pollutes a river, GDP increases from the production, but the cost of cleaning up the river is not subtracted, so GDP may overestimate true well-being. Fifth, distribution is not measured. GDP tells us how much the country produces, but it does not tell us who gets the income. A country with high GDP could have many rich people and many poor people. Another country with the same GDP could have everyone in the middle. GDP does not show this difference. Now let me explain real GDP and nominal GDP. Nominal GDP is GDP measured at current prices. It uses the prices that prevailed in the year the output was produced. Real GDP is GDP measured at constant prices. It uses the prices from a base year. Real GDP adjusts for inflation. It shows how much output has actually changed, not just how much prices have changed. For example, suppose a country produces 10 cars at 1 million naira each. Nominal GDP is 10 million naira. Next year, the country produces 10 cars at 2 million naira each. Nominal GDP is 20 million naira. Nominal GDP doubled, but the number of cars did not change. Real GDP would be the same. Real GDP is a better measure of actual production. To calculate real GDP, you choose a base year. Then you multiply the quantity of each good in the current year by the price of that good in the base year. This gives you the value of current output at base year prices. Real GDP can be compared across years to see how much production has grown. The GDP deflator is a measure of the price level. It is calculated as nominal GDP divided by real GDP times 100. If the GDP deflator rises, it means prices are rising. There is inflation. A common exam question asks you to distinguish between GDP and GNP. Here is a sample answer. GDP is the total value of goods and services produced within a country's borders, regardless of who owns the factors of production. GNP is the total value of goods and services produced by a country's citizens and businesses, regardless of where they are located. The difference is net income from abroad. GNP equals GDP plus net income from abroad. If residents earn more from abroad than foreigners earn within the country, GNP is greater than GDP. Another exam question asks you to explain the methods of measuring national income. Here is your answer. The three methods are the output method, the income method, and the expenditure method. The output method adds up the value added by all firms in the economy. The income method adds up all income earned by factors of production, including wages, rent, interest, and profit. The expenditure method adds up all spending on final goods and services, including consumption, investment, government spending, and net exports. All three methods should give the same total. Another exam question asks you to explain the difficulties of measuring national income. Here is your answer. The difficulties include non-market activities that are not counted, the underground economy that is hidden, quality changes that are hard to measure, environmental damage that is not subtracted, and distribution issues that are not captured. These problems mean that GDP is not a perfect measure of economic well-being. Another exam question asks you to distinguish between nominal GDP and real GDP. Here is your answer. Nominal GDP measures output at current prices. It changes when prices change and when output changes. Real GDP measures output at constant prices. It uses a base year's prices. Real GDP adjusts for inflation. It only changes when output changes. Let me summarize what you have learned. National income is the total value of goods and services produced by a country. GDP measures production within borders. GNP measures production by citizens. NNP is GNP minus depreciation. There are three measurement methods. Output method adds value added. Income method adds incomes. Expenditure method adds spending. Measuring national income is difficult because of non-market activities, the underground economy, quality changes, environmental damage, and distribution issues. Nominal GDP uses current prices. Real GDP uses constant prices. That is all for Topic 7. Practice calculating GDP using the expenditure method. Practice distinguishing between GDP and GNP. Practice explaining the difficulties of measurement. See you in Topic 8.